Hey everyone, today on the final bar, my guest is Javed Mirza. Javed's from Canaccord Genuity in Toronto, bringing with him some long-term charts of equity returns. It'll be interesting to see what a long-term perspective, what sort of framework we can apply to what we're seeing now. The S&P today recovering a bit after selling off from jobless claims, but overall we're still teasing that 3150 level. We just cannot get out of the woods on that. So we'll see how the long-term charts are evolving. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close to look at these markets together through the behavioral, technical, quantitative, sentiment lenses, try to make sense of things, and as always, try to connect the short term of what we're seeing now with the long term. And, you know, if you think about today as sort of a microcosm of where we're at, it's pretty accurate. Plenty of choppiness, plenty of volatility. If you're bearish, you had some validation in the morning. If you're bullish, you had some validation going into the noon hour and in the afternoon. You have some groups up, the NASDAQ going up 0.8%, the NASDAQ 100, small caps down 2%. So it's sort of all over the place. A lot of differentiation, a lot of different movements, but continuing this theme of mega cap tech leadership and other things sort of flat to down. And I think we're going to see that reflected on some of the charts we look at today. Also a bit of a focus on commodities a little later in the show. Now we have some fantastic guests, and we've gotten some comments recently about the quality of the guests, and I 100% agree. We're really, really blessed to have some very thoughtful and talented analysts joining us on the show today. We have Javed joining us from Canaccord Genuity, who I've known for a number of years. I've followed his work and I'm a big fan of what he does. So it'll be cool to talk about the markets with him. Next week, we are doing an entire special week called Charting the Second Half. I'm super excited that it is arriving next week. On Monday, joining me on the show, Rick Bensignor from In the Know Trader. On Tuesday, Tony Dwyer from Canaccord Genuity is their macro strategist. On Monday, on Behind the Charts, it's our interview-style show, a conversation with Thomas Lee, who from Fundstrat, had a great discussion about overall strategy, focus on digital assets, cryptocurrencies, and so forth as well. At the end of next week, on Saturday, July 18th, market down noon Eastern, 9 a.m. Pacific, we'll be doing a market outlook panel, be a live panel Q&A, be able to ask questions of the panelists. I'm super excited to moderate a group of strategists there. So all next week, Charting the Second Half is going to be a really cool group of content for all of you. Let's get to our market recap. So as I mentioned, I think today is sort of a microcosm of what we've seen. It has checks all the boxes that we've been looking for. The number one sector out of the 11 S&P sectors, technology up 0.3%. The NASDAQ 100 up 0.8%. NASDAQ composite up 0.5%. Overall, we finished sort of choppy to down, even though there's plenty of volatility. The S&P settled in almost right to the 3150 level, finishing just above that. That's down about 0.5% from where we closed yesterday. Mid caps down 1.5%, small caps down about 2.3%. So again, this pattern where you're seeing internal weakness, especially in mid caps and small caps, it's one of the warning signals I would be looking for that we've talked about. It's sort of the weakening breadth characteristics. As mid and small cap stocks start to struggle, people go to more of the safety trade, going to the big cap tech names. That would be the last thing that would roll over at the beginning of a further downside move. So again, it's not saying it's the end of the world today. S&P still, holding up pretty well, but it's certainly suggesting some weakness underneath the hood. Let's look at a daily chart of the S&P 500 here. So as I mentioned, finishing just above 3150. The up until this week, the sign had been bullish pennant. We break above 3150 is the level. I think this was Thursday of last week. We sort of broke above that 3150, and I remember thinking, if we can get some validation, get some follow through, I think that points us to 3250, if not even further. Problem is we haven't gotten that validation, that follow through. And when I talk about follow through days, it's all about breaking a certain level and then getting a follow through, right? That next day, a lot of times is really helpful, because what happens, I think, again, I'm always thinking behaviorally. I think people get super excited. You see it, we're breaking above a key resistance level, people pile into it. But after the close, you get a chance to sort of digest it. And then investors would sort of ask themselves, is it really worth continuing on in that path? And if so, that suggests that there's enough buying pressure or buying power to continue the upside move. In this case, we haven't seen it. So every attempt to close above that key 3150 level has been met with a down day immediately afterwards. So we are certainly settling into an equilibrium right around 3150. I think we're still range bound in this overall trend. So I've been asked recently, what do you do here? And I totally get it. We'll try to answer that question on as many charts as we can. But to be honest with you, I think it's tough to justify chasing things that are just in wait and see mode. It literally is a neutral pattern. The RSI is around 56, which is above 50, but it's not dramatically positive. And until we break above those June highs now, I think you have to just question the amount of upside we can have. On the downside, we got a lot of room down to S&P 3000, down to the 200-day moving average, down to the lows from early June. So I think we could even sell off in here a little bit, which I wouldn't be surprised if we do. I think everyone's going to get a little excited. And then the question is, do we hold that key support level or not? Because we've definitely laid out a line in the sand in terms of where demand would most likely come back into the market. Let's look at some of the other charts, see what themes we can tease out. So after technology, it was communication services, then consumer discretionary, 1, 2, 3 at the top. On the bottom, you have energy leading the way lower. This was one of our 3 and 3 yesterday. And, again, we're going to focus a little bit on commodities today, but energy stocks certainly selling off almost 5% down today. Financials as well. The relative strength on some of those sectors has been questionable, and today certainly did not do anything to alleviate that questionable outlook on a relative basis. Even if they've held up on price, on a relative basis, they've rolled over significantly. And energy is probably the worst example. Financials soon after that. And the relative strength of tech versus financials, I think, tells you all you need to know about where institutions are rotating their bets. And given you have to park your money in equities, if I'm looking at these 11 sectors, it's hard to argue against technology being the first place I would want to be aiming at. Only because the relative strength has been consistent. It's been up and to the right, continues to do well. There are plenty of divergences out there. Don't get me wrong. I think that's an important theme that I think will signify sort of the beginning of the end of an uptrend, similar to what we saw back here in January and February. I think we're showing some similar signs to that, especially with some of the big technology names. But until that uptrend stops being an uptrend, and so we get lower highs and lower lows, the uptrend is still in place by definition. Let's look down here at some of the industry and regional themes. So on the global side, China continues to impress with the KBA, the #1 ETF out of the global universe that I look at, followed by some of the other China ETFs as well. EM overall was flat today, but on a relative basis, emerging markets have emerged in very much a position of strength on a relative basis, especially a lot of that driven by China, of course. On the downside, he essentially had developed Europe with Italy, Spain, the UK, France, leading the way lower. In terms of industries, it's interesting, 4 of the top 10 were in the consumer discretionary sector, 1 within consumer staples, which is the food retailers group. It's sort of the grocery stores and others, but broadline retail within consumer discretionary, the number one group. But other familiar groups at the top: semiconductors, software, internet. So these are groups that have been doing well. These are groups that have been outperforming. People are sort of flocking to what has been working. So again, it's not anything about emergence of new leadership. These are groups that have been sort of at the upper end of things, continuing to do well and continuing to hold up very, very nicely. On the downside, you had furnishings was the worst group out of the 100 plus Dow industries that we follow. But other notable participants at the bottom of the group, the airlines group down again today, and again now breaking down through some of the swing lows. So if you look at charts like American Airlines, Delta, and others, there's key support levels to pay attention to there. But the airlines group actually just broke to a new swing low, so confirmed in a pattern of lower lows, lower highs, and in general, those are the charts I would tend to avoid because I'm not a big fan of investing in downtrends. I'd much rather be looking at uptrends. A lot of energy groups in the bottom 10 as well, with oil equipment and services, with E&P stocks, two of the worst three groups. Also, some insurance groups within financials. So financials as a sector rolling over, and you can see State Street was one of the worst losers in the scooter rankings, lost the most in its scooter value today. But overall, a number of insurance companies within that same sector in the lower end as well. It's kind of interesting to see Pulte Homes in here, and I'll pick a couple random things. I'm asked about candle patterns and support and resistance, and I think this, as I was flipping through some of the charts getting ready for the show, I think Pulte Group is actually a really interesting example of a bearish engulfing pattern at a 200-day moving average. We've always talked about, candle patterns are short-term patterns by definition. They're not really designed to be long-term patterns, but seeing when they occur relative to important support and resistance levels can be really, really key. So here you have a stock that's rallied back to resistance. This is an area sort of in that 36-ish, 36 to 38 range, where the stock has topped out a number of times. It's also, every time it's tried to get above the 200-day, it's failed and come back down. Now you have a bearish engulfing pattern, so it's short-term weakness right along a level at where it's found resistance as well. So overall, it actually suggests more weaker rather than positive with Pulte Homes, and you could see again some of the home groups, home stocks down a little weaker today. That's our market recap for today. And again, the general theme I saw on a day like today is sort of more of the same. Market sideways, but with leadership in tech, with weakness under the hood, with a lot of groups, especially with mid and small caps, and that differentiation, that weakness underneath the hood is what concerns me going forward. We need to take a quick break. We'll be back with my guest, Javed Mirza from Canaccord Genuity. We'll see you in a minute. Hey everyone, welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. As a reminder, we love hearing from you, answering your questions on the air. We'll do another mailbag segment tomorrow. Just shoot us a question via email, thefinalbar@StockCharts.com, or on Twitter, just tag us in any sort of comment at FinalBarSCTV. We watch comments on our YouTube channel, and anywhere else you can get to us. Feel free to leave a comment. We gather all of those, and we'd love to answer one of your questions tomorrow during the Final Bar mailbag segment. I want to welcome on my guest, Javed Mirza. Javed's the technical analyst at Canaccord Genuity in Toronto. I've known Javed and his work for a number of years. I'm a big fan of what he does. Javed, welcome back to the show.
Dave, thanks so much for having me on.
Absolutely. So we were talking before we got started. The last time you were on was early March. The world has changed quite a bit since that moment. And I'm very curious where your head is at now that we've essentially round-tripped. We've come back and now, sort of teasing all-time highs, teasing previous highs on a lot of names. But what are you seeing starting with the long-term chart here?
Perfect. So if you recall from my episode, we were actually pretty bullish because at that time our work suggested we were printing an intermediate term or major low, and it is a major low. Now our work suggests that what happened, the whole COVID-19 is more of a black swan event, similar to the stock market crash in 1987. And the reason that's important is because if you put that in context, that stock market crash in 1987 happened within the context of a secular bull market from the early 1980s all the way to 2000. So it sort of, I would say, derailed the bull temporarily. But if you take a look at this chart in 1987, you can see that ultimately the bull was resurgent. And that's what we're seeing here as well. So in early March, it definitely was touch and go. Some of the indicators we're looking at were right at levels where, it could have gone either way. But our view since 2011 is that there's a secular bull market in place that has upside out into 2030. Now, what this chart here does is it affirms our view, because what we're seeing, and we put this out, I think 2 years ago in our quarterly and our big outlook piece we do at the start of every year. And what we're highlighting is that volatility is increasing. Now, Dave, I know you were, I think, you were managing, you were working a lot with analysts during 2014, 2015. And if you recall, and you can see that on the chart, that was the year. Do you remember we had like that day that it was just no volatility exactly where your circle is there? Exactly.
Yeah.
Do you remember the period where the Dow would just like slowly move in minor increments every day? So that was a frustrating period for some people, especially for traders. But what we're seeing here, denoted with the blue arrows, is that we're seeing this secular increase in volatility. Now, that's actually a good thing, because what that says to us is that we're moving into the middle innings of this secular bull market in equities. And you can see as we got closer towards the bubble peak, that's when we actually topped out in volatility. So we think volatility is going to continue to increase out to 2030. And that will be good for active money managers, because in contrast to 2014, it's going to give them a chance to ply their trade and to make more decisions and to add more alpha to their portfolios.
Yeah, I remember that period well, and I remember the pain of the low volatility environment just grinding away to the upside. Now,
Yeah.
chart number 2 is looking more at breadth. What is this telling you relative to the first chart?
So this is one of the things that we were looking at during this whole challenging period with COVID-19. So we look at a lot of longer term charts. It's really important to frame things in the longer term perspective. So when we do this, we have a couple of 80-year charts, 40-year charts, 100-year charts. And it really helps put everything into perspective. And it's funny because that's what we call our piece, technical perspectives. So if you step back and look at the peaks, the major cycle peaks there in 1999, 2000, and in 2007, 2008. And what we're seeing here is exactly, Dave, those bearish divergences. So it's kind of hard to see on the left-hand side because with the data, but the bottom line is the market was making new all-time highs, but breadth was diverging. So this is actually from about a week ago. And Dave, you made a great comment right at the start of the show where you were talking about, look, small caps are weakening, but large cap tech, that's where everyone's piling into. That is not the sign of the healthiest market. Our view is that over the next couple of months, over the summer, so July, August, we're likely to see some consolidation and choppiness. And one of the reasons is exactly what you were saying, is you're seeing this kind of divergence between people piling into large cap tech and the other names are weakening. So we're seeing a little bit of weakening of breadth, which typically presages a correction. But back to what this chart is saying is longer term market breadth is very strong. So we do not see a major cycle peak. So once we see this divergence where the market is making new highs, but breadth is weakening, that to us would suggest that we're getting close to a secular peak. We're not anywhere near that. This bull is roaring on, likely for another 10 years.
Got it. So fair to summarize, short-term, maybe corrective pullback of sorts, but long-term, plenty of signs suggesting there's upside for equities in the coming years, right?
Exactly. And what we think happened is that we just started a new cyclical bull within the secular bull. So the secular bull has upside out to 2030. Cyclical bulls typically last 2 to 3 years. So we should have some pretty decent upside out into, call it 2022 from where we are now.
No, we only have about 30 seconds left, Javed, but we talked about Pulte Homes. I was mentioning it earlier, and you mentioned the weekly chart was of interest to you. What can you tell us? What are you seeing here?
So basically, when I'm doing my reviews on everything, and you were talking about candlesticks, you really like them for the short term. I love them for the longer term, weekly, monthly. What we're printing on Pulte Homes on the weekly time frame is a shooting star. So for those, technical analysts who are savvy with candles, that's a reversal pattern. That's bearish. So not only does the weekly line, the daily lines up with the weekly, and we're right at that critical 50 RSI level. So we're definitely going to be watching this over the next couple of weeks.
It's a great take. Javed, this is fantastic to have you on. Thank you for, spreading the gospel of long-term charting and proper perspective. I very much appreciate it. Hope you and the family stay safe, and we'll have you on again soon, all right?
Thanks, Dave. Love working with you on this.
This is Javed Mirza from Canaccord Genuity. Javed does such a great job of thinking about the long term. And again, it's all about your time frame. I think his comments about looking at short-term pullback, short-term corrective patterns versus the long-term trend and the breadth, the long-term cycle, really, really valuable. We need to move on to our next segment, the commodity corner. So what we like to do is take a look at the commodity complex in focus. It's interesting. My guest yesterday, Landon Whaley, was talking a little bit about commodities. We talked about oil, and I'm thinking of last week, Clive Lambert, or was it this week? They've all blended together. I think that was this week on Tuesday, with Clive Lambert from Futures Techs join us, talking about commodities as well. So there's been sort of a theme to the week, and it's interesting because commodities there's a bit of a divergence of sorts, and when I've seen people look particularly at gold, they're seeing what I'm seeing, which is sort of a long-term secular uptrend. When you look at oil, I think the outlook can be a little more questionable with a little weakness, and you've seen that in the chart of the energy stocks for sure. But let's take a look at some of the charts together and see what sort of conclusions we can draw. So a couple different ways you can look at the commodity complex. The main way I tend to do it is using the DBC, which is a commodity tracking fund. It's an ETF. There are others as well, the CRB index, GCC, a number of them as well. And all of them have their own strengths and weaknesses depending on how they're structured. But if I'm just looking for a basic proxy of commodity returns, the DBC is what I tend to look at. So here we're looking at the last 2 years. And essentially the point I just wanted to start with is commodities as a whole coming down significantly, and energy is a pretty big weight in something like the DBC. So weakness in crude oil certainly is going to be a part of this. But since then, you can basically see it's been in a primary uptrend. And when I say things like a primary uptrend or primary downtrend, I'm simply looking at the highs and the lows. And in general, when something has a pattern of higher highs, higher lows, that's constructive. That tells you that there's a continued upside until that pattern changes. So you need two things to break that cycle. You need a lower high and you need a lower low. So you need to, establish a lower high. You're unable to break above previous resistance, and then you make a lower low, which means you break to a new swing low. Buyers do not come in and provide enough support, and sellers overwhelm and push the price lower. So what's happened in the DBC is it's actually been in an uptrend. There's this really interesting bearish divergence that, it's actually not played out. The DBC has continued up a little further since that bearish divergence in mid-June, which I remember seeing and thinking, well, that's kind of a challenge. But unless you break down through sort of a swing low, it's not really confirming that just yet. What's happened today, though, is you get this bearish engulfing pattern, similar to what we saw with Pulte Homes on the daily chart, an up bar followed by a down bar. So suggests short-term weakness, but overall, the trend has remained positive, uptrend of higher highs and higher lows. So it feels to me like there's a bit of exhaustion with this divergence. We've not seen it yet. I think with the divergence, the bearish engulfing pattern that you see today, I think some short-term weakness certainly makes sense going into the weekend, into the beginning of next week. But overall, it's remaining in a general primary positive trend. Now let's look in particular at two components of that. Start with crude oil, and then we'll go with gold, number two. So with crude oil, this divergence that we saw with the DBC starts to become a little more exaggerated. And in my conversation with Javed just now, we're talking about these divergences. This one comes to mind for me. This peak in early June, the secondary lower peak. Or higher peak in price in mid-June, the lower peak in RSI. We've now, potentially established a new lower high with a bit of a sell-off today. We'll have to see. It's compressed a little bit because of the huge volatility we had in April, but overall establishing a bit of a lower high, it appears, and you can see how the momentum on every one of these upswings has been lower and lower. So there's this overall divergence between strength in crude oil prices and negative movements in momentum, and that more often than not tends to resolve downward, right? So a lower high is step one, a lower low would be the next one. So oil breaking below 37.50 on this chart, and this is using the futures market, would be the indication that that's valid, that we're breaking down, and the RSI breaking down to a new swing low would help to make that case as well. So crude oil feels in some ways like some of the technology names where they are in uptrends, but either making a lower high or getting divergences that suggest to me that we're in the later stage of that sort of up move. For gold, we're going to look at the GLD only because the price history is pretty consistent. It's very liquid. This is one of the ETFs that holds physical gold, so it lines up pretty well to the chart of the gold spot price. Now, this chart in the long term, if you compare it to what we saw with oil, which really ratcheted down in March, April, May have been pretty volatile, and now sort of recovering from that. Gold essentially has been in a primary uptrend with some notable exceptions. And I think mid-March when everything sold off, it certainly felt the pain along with other things. But since then, recovered fairly quickly and then has gone back into a pretty consistent uptrend. Just broke to new highs in mid-June and now has continued higher. Made a new 52-week high again yesterday. Off a bit today, just off 0.25%, but overall, certainly a consistent pattern. What's interesting on this long-term chart of gold is if you look down at the bottom, gold relative to the S&P has been relatively muted. And if you look since the March bottom, essentially what happened is gold rallied along with stocks, but stocks just recovered so much more quickly. And to be honest with you, they had a bit more of a hole to dig out of, but more of a V bottom in stocks meant more outperformance. So gold really underperformed for 2-3 months after the March 23rd low, 2.5 months or so. But look at what's happened in the last 3 to 4 weeks. You can see that the relative strength has started to reverse a little bit. So as stocks have sort of tapered off, as the S&P has been more sideways than up, you can see that gold's actually broken out the GLD above 165, tested it, and now it's gone higher. The question I have now is the fact that gold was just recently overbought. Now, again, in an extended uptrend, things can become overbought and remain overbought, but this has not been the case for gold. It sort of hit the overbought region and come off a little bit. So what's interesting is you have the bearish divergence with crude oil. You have gold just becoming overbought after making another 52-week high. So it suggests to me in the short term, commodities coming off a little bit. But on the long-term chart, there's a lot to like about gold. So I could see this situation where gold continues to hang in there, where oil starts to roll over. But as always, it's all about the price and seeing the confirmation in the price trends. And at this point, both of them are, at least gold making higher highs, crude oil establishing a bit of a lower high here. That is our commodity corner, trying to hit on just the main commodity complex, focusing on gold and oil. So much deeper we can go. But for time, we have to wrap the show, folks, and go right to the 3 and 3 charts in 3 minutes. And here we go. Chart number 1 is looking at the performance of ETFs over the last 3 months. And I'm looking at the US in the form of the spiders, EFA, EM, and the frontier markets. Those are the 4 sort of major global regions that I would look at. If you look at how these have done overall, you can see that EM has really emerged in the last week or so. They'd all sort of been in the same ballpark a couple of weeks ago. This is in the last week and a half of in June. But if you look at what's happened since then, is essentially frontier markets have been flat to down. The S&P, EFA coming up a little bit, but now starting to chop around. But look at how emerging markets have rallied dramatically. Now, we looked at the chart of EM briefly earlier, and as a reminder, China obviously has done very well, huge gap ups, and that's going to cause EM as a whole to look a little more attractive. But it's worth thinking. Charts like this remind me that if you are naked non-US markets, if you are not paying attention to them, I certainly would encourage you at the very least to explore your options, looking at global ETFs, not just in China, in EM, in other places as well. There is a whole other layer of exposure that you can get using ETFs, pretty easily accessing some of those markets. Just make sure that you're focused on the trends. Chart number 2 is looking at China in particular. There's been a bit of a divergence with some of the different China ETFs because of what exposure they have. So if you look at the EWH focused on Hong Kong versus the FXI or the MCHI, with different indexes that they're tracking, the performance is going to be very, very different. But I think it's worth noting the FXI is broken above some of the previous highs and now has chopped around a little bit. In general, you look for a breakout. It's round tripped from the January high, and now it's, do we hold on any sort of pullback? It was a bit of distribution today. This is what you call a dark cloud cover. You have a big up candle, a down candle that breaks at least 50% of the way through. That short term means a little bit of weakness. So you can see this pattern on a lot of charts. I think today has made things look cloudy is probably a good way to look at it. Sort of partly cloudy right now. Short term, bit of pullback, especially coming out of the overbought region, but overall breaking to new highs recently. Finally, I just want to point out bonds had a pretty decent day with the TLT up 1.5%. This is when stocks were coming off a little bit. So you can see that bond prices have completed this transition from a downtrend to a consolidation to now, I would argue, a primary uptrend of higher highs, higher lows and a nice upward move today. You have to look back to some of those previous highs, maybe 171 or so, which would be the peak from April. Not yet overbought, which sort of would line up with potentially stock short-term weak, bonds short-term strong. That's our show for today, folks. I want to thank Javed Mirza from Canaccord Genuity for joining us today. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.